Well, thank you very much, Sauli, for inviting us here today to present on Sampo, the Sampo investment case. My name is Sami Taipalus, and I am the head of investor relations at Sampo Group. As probably most of you know, Sampo is listed on the Helsinki Stock Exchange with a market cap of about 20 billion euros. We are owned about 60% by international investors, and we have about 200,000 shareholders. The story in brief is basically we're a quality compounder with a medium rate of growth, but very high margins, very high returns on capital, attractive capital returns, and relatively low risk and correlation to the broader economic environment. Let's take a step back first and see what we've been doing for the last couple of years. Sampo has been through a strategic transformation. We've gone from being a Nordic investment holding company, willing to invest in pretty much anything Nordic financials, to being a much more focused company operating in the P&C insurance space. The reason for this change is that P&C insurance is the area where we see the highest potentials for creating return for our shareholders over the longer term. It's the area where we see the greatest possibility of building competitive advantages and therefore adding value. The largest steps in this journey have been the sale of our stake in Nordea, which at its peak was around 20% or so, and we sold that down through a number of larger transactions via the stock exchanges, and generating a few billion in excess capital in the process. We've also spun off Mandatum, which is a life and wealth management business that was listed on the Helsinki Stock Exchange earlier this year. The Mandatum spin have given them that company a significantly better possibility to execute on their growth strategy, and it's made the Sampo Group into an even more focused business with potential to create high returns. We've not just been selling businesses, we've also made an investment in Hastings in the UK P&C insurance market. Hastings is a play just on the digital part of the UK P&C insurance market. It's very focused on purely motor insurance and home insurance sold through price comparison websites. And I'll get back to that a little bit more in detail later. What you can see that this transformation has done is taken us from being a relatively complicated group to being something much more simpler and easier to understand. A company basically just focused on property and casualty insurance. What sort of impact has this transformation had? Well, we outline a few of the key points on this slide here. The first and probably most important is that we've closed the valuation gap that we've had to some of our peers in the past. I think the reason for that, well, it's difficult to know exactly what the reason for this is, but I think at least that it's helped that we've become clearer. We've delivered some very robust operational performance. We have executed in a very disciplined manner on capital allocation, and we've cleaned up the balance sheet as well. You can also see that the capital allocation element in the total return chart on the right on this slide, where you can see that we've quite significantly outperformed our peers during this period of strategic transformation, delivering a total shareholder return of almost 50% since our Capital Markets Day in February 2021. All right, so what kind of business are we now if we look forward? Well, I think there's a lot of detail on this slide, but the most important points really are the ones with the green ticks at the bottom, because I think they outline that we have a very, very attractive operational profile now. First of all, we're the leader in the Nordic P&C insurance market. That's about 85% of our business. Why is that attractive? Well, the Nordic market is a market where the large players have focused very much on keeping their own customers, on delivering high retention. And through that sort of focus on service and retention, we've been able to build a very stable market that's very difficult to disrupt. And therefore, with nice and stable profitability, Obviously, there is some churning business as well, which provides some growth opportunities, but that's smaller relative to what you see in a lot of other European market, where a lot of money is lost in intermediated or paying for intermediaries. The second attractive part here is that the business is very focused on private and SME insurance. Private insurance is a little bit more than 60% of the group, and SME adds another 15 percentage points or so on top of that, depending a bit on how you count. Why is that interesting? Well, those are the two areas where you can really build competitive advantages as a business. Why? Well, you tend to have the customer relationship directly, and in that way, you're able to control your business to a much greater degree than you can in an intermediated business. Finally, in the UK, as I mentioned, we're a very focused play on the digital UK P&C insurance market. Why is that good? Well, the digital players in the UK are out-competing the traditional, less efficient, less good at pricing operators. In the UK market, sales are done primarily through price comparison websites, where to be able to compete, you have to be highly cost efficient and highly sufficient at risk selection. And that's the sort of business that Hastings is built around. Right, let's take a little bit of a closer look at the Nordics then. And the key point I want to really get across with this slide is that we are very well able to capitalize on the scale that we have in the Nordics. We're the largest player in the region, and that doesn't just mean that we have more premium than the other companies. What we've been doing very effectively over a longer period of time now is to realize the cross-border synergies that we're able to generate in the market. So if you look at our group-wide functions like claims or IT, for example, those are operated as pan-Nordic functions, which means that we can really realize the scale that we have in the region. Actually, if you look at a market-by-market basis, you can't see it on this slide here, but even though we have good market shares in every market, we're not the number one in any market. And that means that, of course, there is still potential for some growth in each of those markets. We have two fantastic brands in the Nordics, through If, which is pan-Nordic, and Topdanmark, which is a more focused position in Denmark. And Denmark really, I guess, is the market that stands out here a little bit, because that's somewhere where we operate through two different brands. Okay, moving more broadly to our operational strategy. And you could say that it rests on three pillars, really. The first one is customer focus. That's at the very center of what we do. We believe that to deliver customer value in P&C insurance, you need to offer products that are simple and price competitive. Not necessarily the cheapest, but price competitive. And we believe that the best way to do this is by offering very, very good service and really focusing particularly on delivering on the claims side. We do spend obviously some money on marketing as well, but that's not our primary focus, and we don't buy market share by way of, for example, expensive distribution agreements. And where we do have distribution agreements, they're very focused on aligned economics between the shareholders and us and the distributor. P&C insurance is an execution business, moving to the middle of this slide, where you build competitive advantages by doing things better than other companies. Therefore, we are very focused on being able to do that, and we spend a lot on that, on achieving that, particularly in terms of digitalization, and I'll get back to that in a second. By building competitive advantages, we're able to both reach more customers and to actually continue to be highly profitable at the same time. And the competitive advantages are things like, the scale and efficiency I talked about, the service that we have, both in terms of just digital administration and looking after your insurance policies digitally, but particularly the claims handling and delivering on that in a good way. Finally, we do have a profitability objective, given that we're a listed company, and that is something that we think is essential and always very much in focus. We don't do business that's not profitable. Sometimes this is presented as some form of challenge to the listed insurance company model. However, that's not what we've seen historically. Actually, the profitability motive acts very much as a carrot to consistently and constantly improve the business and make it better all the time, which, you know, as I said, in P&C insurance is essential, given that it's an execution business. And we've seen that we've been able to increase our competitiveness over time through this, rather than the other way around. Right, pausing a little bit there on digitalization, given that it's such a key lever in terms of delivering on our strategy. Has been for the last 5-10 years and will continue to be for as long as I can imagine, at least. We have spent more than 800 million euros over the last decade or so on just digital development. So improving, not maintaining our IT systems, but improving our IT systems. It's helped that If was pretty much a blank sheet of paper when it was formed out of Storebrand and Skandia, because it's given us the opportunity to rebuild things in a way that's maybe a little bit different from some other P&C insurance groups. And this really permeates all functions within the group. So everything from sales to service to claims handling to administration, and also internal processes, not just what you see externally. The best part of this has been that we've been able to effectively do this for free. So our expense ratio has actually been going down year on year for every year, the last 14, 15 years or so, despite the fact that we've continuously invested more and more. And the reason for that is, of course, that the underlying business, the productivity of the underlying business has improved consistently. Let's take a look at financial performance and what this strategy has translated into. And I think we have a very good track record. If we start by the last strategic period, we've been able to achieve both our main objectives nicely. So we have our target is to grow underwriting profit by a mid-single digit amount annually on an average over the period. And we've achieved 9% actually to the 9 months of this year. And we've also met our margin target of a combined ratio of 86% or less during that period. A combined ratio is a cost target, so the lower, the better. One small disclaimer here is that there is still 1 quarter left of this strategic period, and we'll come out with the results in February next year, and we'll set new targets in March at our Capital Markets Day. But I'm really pleased to see that we've been able to both grow here whilst as well improving margins. If we look at the longer term trend, you can see that the last few years have been a continuation of a strong track record over a longer period of time. Actually, we've been growing underwriting profits by a CAGR of 11% in the 10 years to 2022. We started from a weaker margin position during that time and have gradually improved it. If you look at towards the back end of these years, the growth in the underwriting profit has come more from top line and less from margin improvements as we've started to reach our target margins, or better margins at least. Let's turn and look to the future. And I want to start by just identifying 3 growth areas that we see as structurally attractive. The first one is personal insurance. As the welfare state has receded in the Nordic countries and continues to recede in the Nordic countries, a lot of people want better health service, particularly for everyday things like just going to see a doctor without having to wait for a very long period of time. So that's offered us and our peers an opportunity to deliver personal insurance products that can fill that gap. We have a slightly unique position here in that when If was formed, much of the personal accident business was left in the part of Skandia that didn't become part of If. So we've been able to rebuild that portfolio from scratch, and it means that actually a lot of the customers we have, we can cross-sell this product to. And that's a very big focus of ours to make sure that the customers that we already have also have this product. Second area here is SME. This is an interesting one because SME business, insurance business, in many ways has been difficult to make sense of in the past. And the reason for that is that the premiums are so small that brokers don't really want to touch this business. There's not a money-making opportunity for them there. However, with digitalization, we've been able to start selling these products very efficiently online, directly to the customers. And with the process being so efficient, it's possible to make money also on smaller premiums here. And of course, again, cutting out the middleman and not having to spend money on distribution. I think we're still at a pretty early stage of the development in the SME business. But I think that this is something is going to be a very, very interesting area over the next decade or so. Finally, on the UK, I mentioned already that we have a structural growth opportunity here through Hastings, where Hastings as a digitally very able business is outcompeting the sort of slower moving incumbent insurers that have been built from a different type of world, where the UK market in the past was focused either on broker sales or on over-the-telephone sales. And those business models have really struggled to adapt to this new world of price comparison websites, where companies like Hastings are highly efficient. Those growth themes I talked about is about 35% or so of the portfolio. So what about the rest? Well, of course, we have the focus on our operational objectives that I've already talked about. But then on top of that, we need to make sure that we continue to price for the changes in loss costs that we're seeing, and that we continue to do so whilst keeping our customers. If we look at the Nordic market, what we're seeing is a continuation of a very stable situation. The last few years have seen loss costs tick up for a lot of our competitors. So a lot of competitors have been struggling with claims inflation, been struggling with maybe higher weather losses as well. And that has hit profitability and meant that they need to continue to be disciplined. We've obviously been able to continue to deliver solid margin through this period, and also importantly, continue to deliver high retention. Our retention rate in the private business is about 90%, which is meaning effectively that 9 out of 10 customers stay with us every year. Inflation has been a theme over recent years. It's not been that bad in the P&C space, or for us at least. We have large purchasing power, long-term agreements on a lot of what we buy for settling claims. And so we've only seen sort of 4 to 5% inflation, and it's been receding down towards the lower end of that range over the third quarter. And in the UK, finally, we're seeing a improving market picture, where it's been a tough market for the last couple of years after COVID, where some companies had excess profitability that's been washing out of the systems. But now we're seeing price increases, depending a bit on how you measure, even in the mid-double digits. So a hard market there gives us a potential platform for growth. Finally, so I've been talking about how we make a lot of money, but how do we spend it? Well, first of all, we have been prioritizing balance sheet repair over the last couple of years. We have a very solid balance sheet now, so that's fixed and nice. We have a very focused M&A appetite. We only look at adding on small bits to the businesses that we already have. There's not much left to buy in the Nordics. And if we looked at transactions in the UK, they would be very, very small in the context of the group. So what else then? Well, of course, we've returned a very large amount of capital over the last few years, nearly 6 billion in total, of which 4 billion or so has been excess capital returns. Our policy is to deliver a highly reliable and stable regular dividend that grows in line with earnings. That was 1.80 last year, €1.80 last year. With the demerger of Mandatum, 30 € of that went with Mandatum, so the base from which we're growing into next year is €1.50. However, the regular dividend is not the whole story. We aim to be very disciplined capital managers, and we have also been delivering and will continue to deliver on excess capital returns. So we're not planning on hoarding the parts of capital that we generate over and above the regular dividend. We're planning on being prompt in allocating that. We can use both special dividends or buybacks for doing that. So to round up then, we are a high-quality company operating with attractive margins and high returns on capital. We expect to generate mid-single-digit growth in underwriting profits. We deliver attractive returns. Our business is capital light. We can pay out a large share of our earnings. Our dividend policy is at least 70%, but we have been paying out significantly more than that historically. So if you add a dividend yield of around, or total capital return yield of around 5% on top of the 5% of mid-single-digit growth that I already talked about, you're already up in, an almost double-digit total return. And then probably the most important thing of all here is that we have a very, very resilient business. The P&C business has a very low correlation to economic activity, and we have a very, very strong balance sheet. That means that we can withstand even if the market gets tough. That's it.
Thank you, Sami.
Thank you.
Have a seat.
Yeah.
Yes. So let's start with the market-related question. So the Nordic P&C market is an excellent market on its fundamentals. Why haven't we seen more entrants trying to enter this very lucrative market?
I think it comes back to what I was saying about the focus being on your existing customers rather than spending all your money on getting new customers. That's traditionally been the focus of the listed companies, but also the mutuals in the Nordic market. We put that service first. What that means is that few people want to change company. And if you have few people looking for new insurance policies, it becomes very difficult for someone to try and steal customers. So, and it also reduces your distribution costs. So when you're not paying someone to try and win new business, you're all the time very effective, and that effectivity gets reinvested into lower insurance premiums. And by doing that, it becomes even more difficult to even steal the customers that other companies have. And that's something that's been in place for many decades now. It's been a virtuous circle that I think has benefited both the customers and the shareholders of the companies a lot.
Then on the interest rates have started to come down, kind of notably. Were you able to lock in high yields in your credit portfolio?
Yes, we have been. So over the last couple of years, the main shifts that we've done in the fixed income portfolio have been to increase the quality of the credits. So we had a high yield allocation a couple of years ago than we have now. We've been moving much more into things like covered bonds and investment grade bonds, as we've started to see attractive yields on those. We have also increased the duration of the portfolio somewhat, so the average maturity of the bonds that we own, which is kind of referring to your locked in point. difficult to rotate the whole portfolio. Our portfolio of fixed income instruments at the group level is 12-13 billion euros. Difficult to rotate all of that. And the window during which the interest rates were high was not that long.
Yeah.
So we haven't, I wouldn't say that we've done everything, but even at the levels where we're seeing yields now, it's not, disastrous levels.
Yeah, I think this second one also refers to that. So what do you feel would be the optimal rate for Sampo? I guess the point is that the zero interest rate environment, it's super difficult to earn anything on your portfolio. Then again, if the interest rate would be sky high, then again, the risk of competitive pressure would arise. So where would be the optimal ballpark maybe on your view?
Yeah, good question. I don't have like a specific basis points number of interest rates for you, but I think a slightly positive interest rate is ideal. I don't know exactly, but I don't know, 1.5% to 3%, something like that, or 1% to 3%, 1% to 2.5%. Why? Well, first of all, it means that you're getting a little bit of economic growth. So that's not a scenario like the one we had for a long period of time where there was no growth. Second of all, like coming back to your point about making money on interest rates, it keeps it difficult to make money in the P&C insurance business. When it's difficult to make money in P&C insurance, it's better for us because then we're one of the best players, and as long as we can use that to our advantage, then that's good. I think it's also actually better for the customers to not have so much price increases.
Yeah. What effects will declining interest rates have on Sampo's insurance business? You partially answered that already, but if you can just repeat what.
I mean, I think the interest rates have moved up and down too quickly for it to really have a significant effect on competitive dynamics, or we haven't at least seen anything significant in that respect. But it does have two effects. First of all, obviously we would have made more money in our investment portfolio had we been able to continue to reinvest. 100 basis point move in interest rates on a fixed income portfolio of 13 billion or so is 130 million or so pre-tax profit. But on the other hand, what you have seen over the last couple of years as interest rates went up was that Nordic P&C valuations went down at the same time. Quite significantly, PE multiples went from 20 plus to something more like 15 or something like that. So I'm hoping that if interest rates come down again, we can start moving back up on that scale.
Yeah. On the competitive dynamics, I mean, last time the interest rates were hovering around this level, the combined ratio levels were, well, at least 10 percentage points higher than they actually are now. So, I mean, do you see that there has some fundamental shift has happened, or is it just that the dynamics maybe haven't had time to work out, and we still don't know where the interest rates actually are over the long term, or?
Difficult to know how things are going to be in 5-10 years' time, so I'm not going to take too much of a guess at that. However, I do think that there have been at least some structural changes. So we have, to begin with, a much larger number of listed insurance companies in the Nordic region now. So Tryg listed in 2006, Gjensidige listed in 2012, and even If. Obviously, it's been part of Sampo the whole time, but that was a very young company if we go 25 years back in time, and they hadn't really had time to do the merger of Storebrand and Skandia and get their act together. Now we have a market environment where we have 4 very capable listed P&C insurance companies that have worked very hard on their business for a long period of time. And then we have a number of mutuals who have maybe slightly different objectives than what the listed companies have, but also a different level of efficiency. And sometimes also different customer focuses. There can be differences in, some companies target rural customers more and other companies target urban customers more.
Yeah. So there is also structural. You believe that
Yes, there are definitely some structural changes, and then exactly what those mean, I hesitate to speculate.
Yeah, I guess we need remains to be seen on that front. Then on the excess capital, you already touched on that on your presentation, but you still have excess capital on your balance sheet. So what should investor expect on the usage of that capital? Obviously, you cannot give any timeframes or anything, and you maybe come back to the CMD. But is it just that you have all the tools available in your toolbox on buybacks and the extra dividends, how you see fit, basically?
Yeah, I see it like that. I mean, nothing has changed in the way that we think about this since last year when we were returning a lot of excess capital. We still have exactly the same philosophy. Where we are right now is that we obviously did the spin-off of Mandatum. If you look at the numbers, the excess capital is not really that huge a number, but we have a number of actions that I think is what you're referring to, that will come true hopefully will come true over the next 2 or 3 years. And as they do, you can expect us to continue to implement exactly the same strategy as what we have done before.
Yeah. Let's then jump in the UK. What was the original reason you decided to expand in the UK? If I recall correctly, it was kind of a surprise for many of the players.
Yeah. The main motivation behind the deal is to have an avenue for growth, a higher growth than what we're seeing in the Nordic P&C insurance market. And that segment in the UK has traditionally seen higher growth than what we've seen in the UK market. Hastings is also a company where we saw an opportunity to make it even more competitive and even better by helping them invest in the operations. It was a company that was extremely brilliant at some parts of the business, anti-fraud, pricing, but then still needed to invest in other parts. So, and being part of a much larger group like we are, they've been able to do that. Then what's happened is that we have had a very, very difficult and turbulent market environment in the UK after COVID. We obviously also had made a lot of money during COVID, but after COVID it's been very turbulent. But now we're seeing that normalize, and hopefully we can capitalize on that.
Still on the Hastings, I mean, the UK market is much more tightly competitive than the Nordic market is, and then in the Nordic markets, your competitive advantage rely heavily on your scale, basically how big player you are actually. So how about Hastings? Do Hastings actually have some clear competitive advantage to build on the growth?
Yeah, the competitive advantages in the UK are different to what they are in the Nordics, and you can see that actually in terms of who've been the successful players in the UK market. If you look over the last 20-30 years, first you have the traditional players, then you had Direct Line come in and basically become the biggest player when the direct model, the over the phone model emerged there. And then when the price comparison websites came, the other companies have receded, and Admiral became the biggest together, and Hastings is also a company that's benefited from that a lot. And the competitive advantages that you need are exactly, you need to have extremely good pricing, you need to have extremely good anti-fraud capabilities, you need to have good claim settlement as well. That's maybe one area where Hastings can still get a little bit better, and you need to be very, very cost efficient, because the sales is based on well, to a very high degree on the price. The price sensitivity is very high.
Yeah, so you believe that you actually hold some competitive where you can actually build profitable growth when the market settles from the current fairly drastic situation, so to speak.
Absolutely. I mean, difficult to rank exactly where we are in terms of capabilities, and I guess we have to respect Admiral's track record on this. But we're definitely one of the best players and best positioned players in the market.
Then on the M&A, you obviously stated very clearly that you have a limited appetite, and in Nordics you don't have too much to do in that sense. But in the UK, there could actually be a lot of opportunities. The market is fragmented, etc. So, what is your stance on the M&A in the UK?
If we saw something interesting, we could certainly think about investing. What is interesting then? Well. You know, within the areas where we operate, so motor or home insurance, and out of those two, probably home would be a little bit more interesting because that's where we lack scale. We have enough scale in motor, and scale is not generally a good reason to do M&A in the UK market. We would ideally, if we got to do a Christmas list here, is also something with interesting capabilities. So be able to add something to the Hastings locker in terms of capability. It's not going to be very big deals. You know, we're talking about most likely a few £100 million of annual premiums compared to a group total of over 8 billion.
Yeah, so in Sampo scale, it even though in Hastings scale it might move a needle, in Sampo scale it doesn't move a needle. Yeah. Then finally, you have a CMD coming up in 3 months or so. What should investors expect about CMD?
Well, without sort of outlining too much detail in at the outset, there's a few things that are I think important. Obviously, what do we want to achieve as a P&C insurance group over the next few years? What does that mean in terms of financials? Or, as I mentioned in my presentations, our financial targets run out at the end of this year, so we need to set a new financial ambition for the next 3 years. And then there's a number of actions still to do in terms of, you know, we're a group that's changed the structure a lot. There's a number of things still to do to optimize the way we look now, and one important one of those is how we run the balance sheet. And we're not doing that necessarily yet in the most optimal way, but we can still work on becoming more efficient.
Yeah, let's wait 90 days or so to see. Thank you, Sami, very much.
Thank you very much.
Answers. And this concludes our event here tonight. I thank you very much for joining in, and I wish you all a Merry Christmas and Happy Holidays.